Welcome to the Writing Gals. We are four sweet romance authors staying up late as we talk about writing. And tonight we are super excited to have Bridget Baker on with us. And she's going to be teaching us all about author taxes because it's that time of year that we need to be thinking about it. And she is an expert. And so we're just so excited to have her. But first, we wanted to kind of give an update on what all of us are working on right now. So let's start with Victorine. What are you doing?
Yay! All right, I'm super excited about this young adult book I'm writing. I'm in the middle of it. It's called Don't Bet on Love, and it's just a young adult story about a football player who bets another football player that he can't get a girl to date him, and it's super fun. So I'm having a blast writing it.
Awesome. I'm super excited to hear it. What about you, Amy? What have you been doing?
Well, I am juggling two books right now. So I'm writing the first in my Brothers series, and I'm writing the first in our Sweetwater High collaborative series that will launch at the end of February. And then I'm super excited because on Saturday, I'm going to get a photo shoot done for my prep school series. I found a photographer and some models, and we're going to go take all those photos for that series. And I really think that custom photos are like the way of the future, because I think especially as we go into Clean and Wholesome gets bigger, the need for custom photos are going to get greater. So I'm really excited that I'm introducing this photographer to covers. And hopefully when Michelle gets her cover image site running, she can download photos there, and if not, do more custom photos for people. I just love the idea that I can go out, find people who have a talent, and figure out a way to help them make an income through writing. And I think there's such a need for us to have Clean and Wholesome. And then tonight I was at a thing with some ladies, and I found out I knew her husband is a firefighter. And so I was like, ooh, would he and like some of his groups, like firefighter friends, take photos for me so I can do a firefighter series? So we're starting to plot that as well. So I'm really excited to just keep moving forward, I guess.
Oh, that sounds fun. And Michelle, what have you been up to?
It's just touching base on what Amy was saying. There was a time I was at the city pool with my kids, and this guy showed up, and I was like, like, how do I get him on the cover of a romance novel without sounding really creepy?
Well, that's what me and my photographer were talking about, because I go to a gym and I'm like, there's so many of these guys that I could totally put on my cover. And she's like, I'll give you my card, and you can just be like, contact my photographer and we'll pay you and we'll take your photo. You can be on my cover. She's like, so many people will like respond, especially if you say we'll pay you.
There's nothing else to have bragging rights.
Right.
So, okay, so what I'm doing this week, my husband's out of town for work, and I thought I would get so much work done, and it's turned out to be the opposite of that. So I kind of slowed down my ambition and settled into my Regency romance, To Love a Gentleman, spent some time sort of deconstructing, sorry. Facebook's going to keep me jumping here if I don't click it off. Okay, so I spent some time deconstructing it and figuring out photo shoot for the cover, which is a lot more involved than contemporary because I have to figure out costuming, somebody to make me short stays to try and figure out if I can do a dress without the correct underwear underneath. I mean, like, just like all of this stuff is kind of a nightmare and super fun. I did spend some time on Saved by a Movie Star, and it is going to be fabulous if I ever finish writing it. My goal is to get it done by the end of this month, so we'll see. And one of my big highlights for this week was my husband on his trip was reading one of my books for the first time ever. I've got 15 stories written or more, and he's reading one for the first time. He got to chapter 11 by the time he got to his work site. And then he just texted me before I got in here that one of his work buddies, is going to read one too.
Oh, wow.
Who knew there was such an untapped market for men reading these romances? So anyway, that's what I'm up to. Apparently I'm breaking ground in a whole new market.
That's awesome. That's good. And what about you, Bridget? What are you doing?
So I am a burst writer. I just wrote my 14th book last week. But it's just works out that more than half of those I wrote in a week. Because I usually, if I start writing, I write a lot faster if I write in close proximity. So when I'm writing a book, it's almost like, you know, the people that I do this to that are like, I've got to lose some weight. I'm going to go on a diet. You get ready for your diet and then you start your diet and you with it really good. But if you're not in the right mindset, you can't do it. So I do the same thing. I'm like, all right, this is when I'm going to start my book. It's like I'm getting ready for a marathon. And then for 12 days, you know, in this case, 6 days, I wrote like 12,000 words a day and then the book was done. So I just finished. It's a romance. It's I wrote my first romance was a Christmas one called Finding Santa. And so I just wrote the second in series. It's called Finding Cupid. It's going to be a Valentine's romance. So then I'm editing it now. So
awesome. I wish I could write that many words in a day. That would be amazing.
You know, everything else slides though.
Yeah.
So
Still, that's good. So for me, I finally wrote 2,000 words in a day, which is like a big deal as of late because the last 2 months have been not so great for writing for me. So I'm just really happy that I did that. And I'm hoping that I can keep up the momentum and get this book finished by the end of the month. That's my goal. And then besides that, I've been listening to my audiobooks that just came out, which has been really fun. The first two in my Ridgewater High series came out over the last few weeks. And so I've just been enjoying those and it's been fun. So yeah, that's what I have been doing. So let's get into the fun stuff of tonight. First, I will introduce you to Bridget. So Bridget Baker graduated cum laude from BYU at age 19 and went to University of Texas for law school. She was the youngest lawyer in Texas for 3 years. A mother to 5 children, she teaches kickboxing and is a room mom. She currently has her own legal practice and works as in-house counsel for a local company. She handles a variety of tax issues for her clients, including tax preparation for a select few. After going to acquisitions with 3 different books through an agent, she met Elena Johnson at Storymakers in May 2018 and decided to give indie publishing a try. Her first series, YA Post-Apocalyptic, released September, October, November of 2018, and she released her first sweet romance November 1st. She put out another young adult romantic suspense this time last week and has a new romantic suspense coming out in 2 weeks, the second in her Almost a Billionaire series. So she has been very busy, and she sounds like she's a super genius, graduating at 19, and then, so I'm really excited to hear more about what you have for us. So let's first kind of start out with like basic.
Can I ask Bridget a question real quick?
Oh, go ahead.
So why this is what I think of when I hear people who have pretty high-powered jobs becoming writers. Like, why did you want to not give up, but move to being an author instead of continuing being a lawyer?
So what's funny is Judy mentioned that I graduated at 19, and I didn't know what I was doing at 19. In fact, when I was at BYU and I never went to a counselor, I thought that my parents told me they were kind of useless. So I looked at the course catalog and said, I don't know what to do. So I just thought, well, everybody's always told me I'd be a good lawyer. I'll just do that. And so I just thought, why not? Took the LSAT. Like 2 weeks later, I had to get a standby spot and applied and went to law school. I'm like 19 years old. I have no idea what I'm doing. People are like, what kind of lawyer do you want to be? I'm like, there are different kinds. I don't know. I mean, it's like so clueless. So I went to law school with no real idea. I didn't even watch legal shows. So I didn't even know what lawyers did. My dad was an engineer. I didn't know anyone who did it. So I got out of law school and had done some summer jobs, but summer jobs as a lawyer, you basically do nothing useful at all. So I got out and started working and realized like, this is boring as crap. And I mean, some of it was interesting, but the stuff that was interesting was also stressful. So I did that full time for like 6 years. And then while my husband was in residency and medical school and all that, I worked part-time from home with the kids. And that's when I realized I started having ideas like for stories. And I thought, maybe I could like blob a story out and be a bestseller. kind of cool. So I literally thought, oh, this would be super easy. I mean, if I can be a lawyer, I can definitely do this. So I promptly wrote a book that was absolutely horrible. I was so mad, but I sent it to my friends. And what I remember is that it was like started out as a fantasy set in another world. And halfway through, I was like, you know, it would be awesome and super unique if my character woke up in the middle of the book and really all of this was a dream. They're like portended of things to come. And I was so mad. My friends that read it were like, well, I kind of liked it. And then randomly, like, bam, it's like I was getting slapped in the face. This thing happened. Like, I know, wasn't that cool? And they're like, sure, yeah. So, you know, you're seeing a little more why it took me so long to get here. But so I thought, you know, this will be easy. I didn't realize that the kind of writing that you do as a lawyer is actually almost as far as you can get from the kind of writing you want to do as a novelist. It's, I mean, the training, it would be like being trained to go down a slide and finding out you were supposed to be swinging. You know, like, I mean, it was complete night and day. So it was funny because I originally, in my million typewritten queries that I mailed to people with a self-addressed stamped envelope, and all of those, I said, I'm a lawyer. Like, the agents would be like, oh, we better sign you tomorrow. Anyway, so I did a lot of things wrong, clearly. But the reason that I wanted to switch, so if I wanted to make money, law is the way to go. The practice, so the people that worked for me, like I supervised their work, are now partners at the firm that I was at, and they have their own private jet. The firm has 2 jets. So I was their boss, so I would be making crap tons of money if I were still there. But I think what you find is that, and you know, my husband's a physician and he earns a good living. So I have been lucky in that I can do what I want, and I don't have to make decisions based on where can I earn money. But so that's been freeing in a lot of ways. And I know that kind of makes me spoiled. But I'm also in a situation where I have to look at, I would like to earn money, obviously who doesn't, but I wanted to do something that at the end of the day, I felt good about doing. So I don't love revising still. I'm sort of put it off a little bit. Like Judy was saying, she hasn't had a great couple of months with her words. Well, sometimes when I'm looking at a bunch of revisions, I have a pretty lousy couple of weeks because I'm like, just focus. Oh, you know what? The dishes are dirty, you know? So I kind of do a little of that with the revising end. But on the drafting for me, like writing a story is like, it's my drug. I mean, I'm Mormon, so I've never done drugs. But if there's a drug for me, it's writing a new book. I finished this one. I was super excited to finish it. I told my husband, I'm like, maybe instead of revising it, I should write the next 2. I've already got the ideas. I could just write those over the next 3 weeks. Wouldn't that be great? He's like, no. So, you know, I think that's how I ended up going from law. But of course, I still do law. I've got clients I can't really shake. Sorry, guys. But I've tried to pare it down as much as possible. So I should say at the beginning here, I am not looking for clients. So, you know, some people might do one of these podcasts because they're thinking, hey, you can reach me on Writing Gals and I'll do your taxes for you. That is not the case. Okay. I do not want clients. No thanks. Find an accountant. We'll talk about that. One of the questions is about that, but it's not me. So
awesome. Love that. Okay. So can we first start with some basic tax structure stuff so that we're all on the same page, and talk about some new changes that are in your taxes this year? Maybe starting with the income types and locations.
So that's perfect because what I really like to do, so here's what I find. I know that everyone who's watching is going to be coming at this from a different angle, a different level of experience. You guys are all going to have a different comfort level with taxes. Some of you are going to be doing TurboTax, and you may know fairly well how these pieces fit together because you're the one who's actually doing the Excel puzzle every year. Some of you may be compiling I have a client who brings me a box, like a moving box full of junk. And then I have to sort through all this crap and figure out, and like 60% of it is not anything that we would ever use for taxes. It's horrible. So I'm trying to train my clients better, and some of them are more receptive than others, but don't be that client. Okay, your accountant will hate you. But so what I'd like to do is make sure that we're all kind of on the same page. So some of you may be able to just take the little cursor and go and fast forward because it'll probably just take a second. But let's first of all talk about the types of income, because if you don't understand this stuff, when I start talking about deductions and where they go or the changes in the law, it won't make any sense. So when you're looking at a tax return, and I actually am going to see if I can do, there's a little, I don't know how to do it. There's a little thing that I can bring the screen up on here, but for some reason it's not doing it now. I tried it earlier. Screen share.
Over to your left, green screen with the white arrow.
Yep, it finally popped up. So I thought I pressed it. Anyway, if I can get the screen share up, then I will, let's do this. Okay. All right, theoretically, I told you I'm not so great about about these things. Okay, so what I wanted to do is just bring up one of these. What I did is in preparation for this, I pulled up two completely fake, you'll see the names, they're ridiculous, but I made up income because everyone's gonna be in a different place. And so I made up two. One of them is where the main income for the family is coming from the writer. And the other one is where the main income for the family comes from another source, and writing is kind of like a secondary amount. So
there you go.
Did that work? Okay. So the reason that I put this up, I'm going to start with the one where the writer is the predominant bulk of the income. Okay. So when you're looking at this screen, what it'll do is you can look, line 1 is for wages and salaries. So anyone who is an employee, anyone who is hired, this is probably the most common type of income in America, is earned income, and it just comes from a W-2. Okay, so if you're getting a form from your employer and they're withholding taxes, that's W-2 income. Okay, it goes on line 1. The next kind is going to be, I'm going to call it passive income, but it's basically going to be dividends, whatever, interest, that kind of stuff. We're not going to talk about that much today because your writing is not passive income. You're actively pursuing your writing. Some people will say, oh, well, the greatest thing about writing is that you can earn money. You're not even doing anything. It's just sales on Amazon. But for the governmental perspective, this is not passive income. Our writing income is earned income. So we'll get to that in a second. And then the next kind would be like sale of assets or sale of land. We're not going to talk about that either. So what we're really going to be focusing on today, unless we get down to the section on structure, and we kind of put that last, we'll see if we have time. And I'm talking about corporate structures. So whether we do something like like an LLC or an S Corp, or just have it as a sole proprietorship. We'll talk about that maybe later. But if you look right here on this line 6, where it says total income, there is something there that's showing up that 61,296. Okay, that number is coming from down here. If I scroll down, this is the new form, by the way. So if you're used to looking at a 1040 from prior years, it was 2 pages long. And you signed at the bottom. And you'll notice now here, you sign here on this little sign here thing, like in the middle of the page. And it has all this information underneath it. So it's kind of a, we were talking about new stuff and we haven't really gotten to that yet. But when I scroll down here through some of these forms, here is the Schedule C, okay? And you're gonna hear us talk about Schedule C a lot. And we can come back to this once we actually start talking about deductions, I guess. But this Schedule C is the type of income that probably 90 to 95% of you guys are going to be dealing with when we talk about taxes for writing income. It's going to be that Schedule C. And we'll get to that and talk more specifically, but that's the types of income. And then when we talk about, these are just terms of art. So if this makes sense to you, you want to write these down, okay? A deduction, a credit, and an exemption. People use them interchangeably a lot, and they're not the same, okay? So when we're talking about tax stuff, there's income from a variety of sources, but we're gonna lump it into 2, passive income or earned income, okay? And then there's also these 3 terms, and I wanna make sure we all know what they are. So the first one is a deduction, okay? A deduction is gonna be a reduction of your income. So if your total income is $100,000 and you have a deduction of $10,000, then that will reduce your income for tax purposes from 100 to 90, okay? The second one is a credit. A credit operates differently. If we're looking at that tax form and we're saying, this is our income, blah, 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 here's our tax liability, and this is what we owe, that credit comes in down here near the bottom. It says you owed $8,000 in taxes, but you have a $2,000 child tax credit, so you only owe $6,000, okay? So a credit is actually money that's credited towards you as though you had paid taxes, okay? So it comes off the tax liability, not off the income. And then the last thing is an exemption. And I hear people all the time misuse deduction and exemption, and it gets confusing, okay? An exemption is something, and some of that's shifting this year, but that's probably beyond the scope of this discussion. An exemption is basically something that you can take based on the number of people in your family. So if you're just by yourself, you're going to get an exemption for you for being a person that you can take off from income. It's kind of like the government gives you a little present. You can just knock that off your income amount. Okay. I'm oversimplifying a little bit, but that's the exemption. It just kind of comes off. And when you have more kids or you're married or you have more people in your family, you're going to have more exemptions that are going to come off. So it sort of operates the same way as a deduction. And that's why people interchange them. It is an income reducer, but it's technically not the same thing as a deduction, and they're taken in different places. So that's just so that when I'm talking, you guys can hopefully be on the same page as to what we're talking about.
So a deduction is like where you've actually spent money and then you're deducting that from your income. That's different. Like, so
yes,
it would vary different from people to people, because if I spend 10,000 on Facebook ads, but you only spent 5,000, but we could get the same type of exemption by having like kids or something like that.
That's correct. Right. And so then let's talk about the different kinds of deductions, because that's a great question, because that was where I was going next anyway. Okay. The different kinds of deductions, all right, are number one, an itemized deduction. Everybody's heard of that, okay? Probably. And that's one of those things where you have to come in and decide, do I want to take the standard deduction that everyone is offered for being a person, or do I want to itemize? When I'm talking about itemized deductions, I'm usually talking, there's a whole slew of things, okay? But for the sake of what we're talking about here, the main ones are going to be healthcare, which you can only take if it exceeds a threshold. So most people can't take that anymore. The second one is charitable donations, okay? And those actually will come up in response to another question someone asked later. So if you were to make a charitable donation of cash or in kind, whatever, that's an itemized deduction, okay? And then also taxes that you pay on your house, or mortgage interest that you pay on a house if you own one. Usually when clients come to me and they say, am I someone who would want to itemize? I'll say, do you make a lot of charitable donations? Do you own a home? If you own a home and you're making a payment on it, so you pay property taxes and interest, you're probably going to want to at least see whether you should itemize. And then that's just a numbers calculation that your preparer can do to say, do my itemized deductions exceed what I will get with my standard deduction? And if they do, then you want to keep track of those. And that will get you a bigger deduction. Okay, so when we're talking about your income, let's pretend it's 100,000. Okay, what you want to do is get that as low as possible. Almost all the time. Okay, there are a few exceptions, and we'll get to those. The other thing, I meant to start this disclaimer. I just wanted to say this is not me giving legal advice. None of you guys are my clients. I'm just kind of discussing this stuff with some friends here. So we're going to talk about scenarios. Some will be made up. Some I'll talk about my own. You guys can ask me questions and we'll talk about yours, but I'm not like anyone's attorney here. So I just want to throw that out there. And one of the things that you'll find, and I'll say this a lot, some of this stuff with the tax law, I'm really looking into a crystal ball, because everyone's situation, when I give you advice and I say generally this is true, everyone's numbers will be different. And there are a lot of these things, when you look at these, they tie into each other. And so, for instance, when I was doing this tax projection that I'll show the screenshot again in a minute probably, I was trying to figure out what things to put in to give you guys an example. And I was like, oh, well, we'll lower their taxes a ton by throwing in an IRA, because I thought we'd talk about SEP IRAs. One of the people, I think it was Lindsay Armstrong, asked about deductions, or maybe it was Sally, I don't remember, that you could take to lower your income. And because of where the income was and the qualified business income deduction, the IRA hardly did anything. Whereas someone who was up here, it would make a huge difference. So a lot of this stuff, this is why I'm saying this isn't me giving you guys specific legal advice. This is why you need to either get a preparer or do some research to figure these things out yourself, because what works for one person may not work for the other, depending on spousal income, depending on what your income level is, what other deductions you have, okay? So the other big kind of deductions that we're gonna talk about today are business deductions. So there's a big difference between an itemized deduction, that's just crap that you have for your life, versus a business deduction. A business deduction is going to come on your Schedule C, okay? So when I pop up this thing, and I'm gonna screen share again, because when I popped up the Schedule C, I'm just gonna show this real quick because I think it will help. So when you're looking at the Schedule C on here, I put in the gross income for this person at $85,000. But when you look here on this 1040, the gross, or the income that's showing as earned income, is $61,296, okay? That's because the business deductions come off the income before they even go on the tax form, okay? And then you're gonna see over here, you're gonna see standard deduction or itemized deduction. And in this case, it'll say over on the side, see single or married filing separately is 12,000, married filing jointly is 24,000. That's new, by the way, for this year. So right here, this $24,000 is the standard deduction, and that's what's being taken here, not the itemized deduction. So the itemized deductions on this person's return were not higher than the standard deduction. So when we were looking at this return and we're talking about deductions, we're going to be looking at standard deduction plus business deductions. I hope, does that make sense? Do you guys understand what I'm talking about? Okay. Okay, good. So, and then I think the only other thing I wanted to talk about briefly before we move on to questions is something called the Qbi deduction. Has anyone heard of that? Okay, so the Qbi deduction is new. It's one of the Trump initiatives or whatever as part of the new tax plan. It's the qualified business income deduction, okay? And this is one of the reasons why, to a certain extent, especially for authors, the landscape has changed. And we'll get to this when we talk about structure below. But there are a lot of my friends that decided to do an S Corp and are now hurting because of the way they set up the S Corp. They're not able to take that qualified business income deduction to the fullest extent. Here's how it works, okay? It is only for people that are earning essentially self-employed income. So if you are, I'll try to avoid the structural stuff. Let's say you're an author, you're the only person in your business, whether it's a sole proprietorship or a single member LLC, it doesn't matter. If you're reporting it on a Schedule C, see, we're getting into structural stuff here, which I'll try and address at the bottom. So let's just pretend that you're single member LLC or you're unincorporated, okay? And if that's the case and you're reporting your income, then you're able to actually, as long as you're under the thresholds, you're able to take a 20% deduction. So I'm gonna go to the screen share again because you're gonna see it show up on here. Because that 20% deduction is in this tax return. So share this. All right, you're gonna see QBI. So if I go back up to the top page, sorry for the scrolling, guys. If I go back up to the top page, you can see the reported earned income after business deductions is $61,296. The adjusted gross income that used to be at the bottom, if you're familiar with tax returns, that used to be at the very bottom of the first page is $50,000, okay? That puts us down here with a standard deduction. Qualified business income deduction is line 9. Look at line 9 here. That's a 20% deduction off of your earned income. Okay, it's a little more complicated than that because it's technically off your taxable income. But what happens is that QBI now comes off. It's basically like President Trump came in and said, the government was previously almost penalizing people who were self-employed because they had to pay self-employment taxes and they didn't have anyone footing part of that bill. And they also had to pay all of their expenses without any kind of benefits or anything else. So he said, we need to give them some kind of incentive to start businesses instead of this disincentive. So now there's a 20% deduction that comes off of all earned income that's under certain thresholds. If you go over $315,000 of taxable income, that's not gross, but taxable income, then you're excluded. But otherwise you get a 20% deduction. That can add up to a lot of money. So we're excited about that.
Can we just pause and go, woohoo, woohoo, woohoo?
Yeah, I did my taxes this year, and for the first time when I did my tax projection for 2018, I didn't have to pay quarterly taxes for the fourth quarter. That happened in like 6 years.
Well, I'm excited too because like when I did my estimated thing this year, what I thought I would make, I overshot that, and so I'm like, dang it, my whole tax thing is like, oh. So maybe
yeah. So hopefully that QBI will help make up any delta, and you were worried you were going to have to pay. Because I've had a ton of people that have come in for projections, and they found that they're actually way better off than they thought they were be because of this QBI when they're self-employed. So that's a good thing. So then I think that's probably, do you guys feel like you understood most of what I was saying?
Yeah, that was fantastic.
Okay.
I'm like,
okay.
Yay, praise you.
Yeah.
You're awesome.
Okay.
I'm just like still on this 20% like coupon we've been given, which is amazing.
Yeah. For self-employed.
215,000 net. So, we're all like, woohoo, this is amazing.
Yeah. So, and actually what's interesting is even people that have earned income of 500,000 can frequently come under the net. So if Elena's watching, no, I don't know what her income is, but I'm just saying people that are really at that upper end, you can still get it down because that's the $350,000 cap to be eligible, and it is phased out. So even if you're above it, you still get some of it. But even if you're above that for gross income, as long as your taxable income comes down below 315, which all those deductions, itemized deductions and all that stuff comes off first. And we can talk, if we have time, about SEP IRAs. I don't know if anyone even wants to know about those, but SEP IRAs are an amazing way, if you have extra income that you weren't planning on having, for you to lower your tax liability and put money into retirement savings, that it's not limited to the typical like $5,000 a year, $6,000 a year, whatever IRA limits. The SEP IRA, you can sock away up to $55,000, I think is this year's limit. But it's a percentage limit too. But anyway, it's a way to, especially if you haven't been saving aggressively for retirement, to really start to make a dent in your retirement savings. We max out our SRA every year. So anyway, all right. So now I think we can probably go to the questions, unless anybody had any questions about that.
No, I don't think so.
Okay.
All right. I am going to jump on then and ask you some questions about deductions, because everybody wants to know about that, right?
Yeah, that seemed to be the heavy hitter.
Yes, definitely. Marika Ray would like to know, she would like a laundry list or a discussion of everything that can be used as an expense or a deduction as an author.
Okay, so I think a lot of people were kind of looking for a laundry list. So what I wanted to do is give you guys an overview of the type of things that you can deduct so that you get an idea for what to do. And then we'll go through and hit some of them. Like I know travel and stuff came up several times, so we'll hit those in a little more detail below. So for the list of deductions, I'm going to go ahead and say travel, conferences, but we'll talk about the specifics of how to deduct those later on. So one of the things I was going to do is show you guys, and I don't know if you can see it on here. This is my handwritten notes. Let's see. Can anyone see that? So this is a list of my specific business expenses. I'll just read some off because I think it's probably hard for you guys to see it. But I did a lot of things before I started actually publishing that I considered to kind of be general startup stuff, okay? I subscribed to Query Tracker back when I was still with an agent, okay? I subscribed to Publishers Marketplace. I bought a new laptop. I bought Vellum. I signed up for a website and paid for a domain name. I paid someone like $350 to help me brand my website. So stuff didn't, I'm a tech idiot. Okay. So, but BookFunnel, MailerLite, KDP Rocket, an AMS course, reader links. I paid for all this stuff that wasn't linked to one book. Okay. What you want to do, and I'm going to answer, I know this is one of the questions later on, but I feel like you guys need to know this now. You need to have receipts for this stuff. And a lot of it, especially for authors, we're not getting a paper receipt. We're not going to Home Depot and saying, I'd like to buy Vellum. Okay. So the receipt that you're going to get is an email. If you are organized and conscious of the environment, what you should do is open a file right next to books, maybe, make it fancy, big font, tax crap 2018. Okay. Save every single email. You click print to PDF or something, you know, however you want to do it, okay? You can save every single one of those in a file, and your accountant doesn't even need those, by the way. They just need the numbers, and I'll tell you how to make your accountant love you, okay? But what we need to do is save all of those things. And so some of the promos, because this is just general stuff, right? Then I have a book page, right? Some old school. I wrote all my stuff down because I wanted it broken out by book. So for the Marked et al., so that series I put out, those 3 books, okay? I have specific stuff. I paid for a lot of editing, all right? So I had editing, copy edit, covers. I paid for a Kirkus review because I'm dumb. Anyway, I paid for blogger books and author copies and all that. Okay, we'll get into a little specifics because people had a lot of questions on that kind of stuff. But I kept a record of each book's things because I wanted to be able to break out, this was this book, this was that. For tax purposes, it does not matter unless you are somehow registering your entities separately. Like I have a friend, okay, she writes nonfiction, she writes fiction, okay? She has done an LLC for each. So she needs to keep track of her business stuff separately because they're going on different Schedule Cs. So what you'll see when I go to this screen, if I end up going to the first projection that I did, I showed you guys the second one first, but the other projection, we'll just say that I did, the spouse has a Schedule C and the writer had a Schedule C. So the It's like kind of a fake, not accurate numbers, but fake projection of like my husband and I, okay? Because he has money, but his is also in self-employed income. So it's a Schedule C. You can have like 6 Schedule Cs, by the way. You can have one for everything. You can have one for this and that and this and that. And it's a little annoying, but it's not really that. Your accountants, if they whine, you need to tell them to shove it. So on the multiple LLCs, that's not that hard. They just drop the number in a different box. So if you give them a box of junk they have to sort through, then they should fire you. But otherwise, all right. So on deductions, I think the business ones are fairly straightforward, and people had some questions that we'll address with comments later. What I wanted to go over and what things you can deduct on this list, I'm going to go to a screen share again. I hope these are not annoying. Are these irritating for you guys? Okay.
No,
So there's okay. So this one is kind of a messy screen share, but I brought it up because this is what my screen looks like. Why didn't it bring that one up? I didn't want that one. Hang on. It did it wrong, I think. Is it showing you guys a picture that looks, oh, it is. Okay, all right, never mind. It just brought up a different page for me. So so this is a picture of my, what my tax screen looks like when I am filling out a form for a client. So this is my software, and I don't know if I can zoom in. I wonder, does it zoom in for you guys? Oh, it does, okay. So, all right, when I'm filling something out for a Schedule C for the client, this is what I'm putting in. Right? I give it a name, I give it a product, I give it a title, okay? The reason this is helpful is this form shows you guys all of the deductions that can be taken on the Schedule C. It may not all make sense to you, but I thought I would walk through these and then we can talk about the ones you guys want to know more about, okay? So this right here shows your income, okay? It says gross receipts or sales, and I put in 38,700. Ha ha ha, I didn't make that, but let's pretend that I did, okay? I told you these were phony baloney numbers. So let's pretend that I made that in 3.5 months last year. And then my advertising was 10,000, and that's actually closer than it really should be for 3 months. But so there's my advertising number, okay? We all know you can put in advertising there. And by the way, for advertising, you can put in Facebook. You can, and one of the things that your preparer can do is click on that little box, and they can put in AMS ads as one number. They can put in Facebook ads as one number and promos as one number. Or you can just send them a number and say my advertising was 12,000. They don't really care unless you want to be able to track it at a later date and say, year over year, can you give me my numbers? Because a lot of my clients want to know that, and I keep track of it in my software. So some of that depends on your preparer. All right. The next thing here, car and truck expenses, okay? See how it has a little blue thing next to it? That means I have a whole separate schedule that is attached to that deduction, okay? Because there are 2 ways you can take auto expenses. I'm gonna skip over this one because I'm guessing most of us as writers are not doing a bunch of driving around that's affiliated with our business. But to the extent that you do driving, you can keep track of your mileage. Your best bet is probably going to be, unless more than 50% of your mileage is for writing on your car for the year, you can't depreciate your car. So you'll probably just want to say, hey, I had 1,200 miles. I drove to a conference or something like that. You know, write that down because you get like 55 cents a mile or something like that. So that'll actually make a difference. But all you really need to do is keep track of your mileage. And what you need to have for your records from an IRS audit perspective, your accountant does not need this. They just need a number. They need a number. I drove 1,000 miles that was business related. I drove 12,000 overall for the year. Those are the numbers they need. And unless it's over 50%, you're not going to depreciate. So, but what they will need is you need to have at your house. I told you keep receipts on everything, either in a file or I'm kind of lazy and apparently hate the environment because I just print mine off. When I get something, I click print and then I stick it all in a box for me. And at the end of the year, I go through it. Okay. So, but on that, you need to have a little written log. Okay. And I just write it down. I say 19, 22 miles, drove to pick up printer cartridges or whatever, okay? Whatever it is, you can keep a log for that, and you got to think about it. 50 cents a mile, it could add up if you're ever driving anywhere for book-related stuff. Okay, book signing, whatever. All right, so then I'm going to go down, commissions and fees, okay? I don't know whether any of you guys would have these or not, but certainly fees you might. You could break out fees and things like, you know, your reader links or whatever, that stuff could be put in there, or book report, you could put that in fees. Usually it's bank fees, but it could be anything that qualifies as either a commission or a fee. Contract labor, this will come up again later because this is one of the places that you could be paying other authors if you're in a multi-author set. Okay, so like let's say you're the lead author and so the book is under your KDP dashboard or however, you know, if you're wide, I don't know how that works because I'm not wide. But however it is, if the money's coming to you and you're distributing it out, this is one place where you can say, hey, I'm making payments. And if it's over $600, you're going to have to do a 1099. If it's not over $600, then you're actually home free. You can just put a lump number in here. Like I paid 4 different authors $400 each. So you can report, you know, $1,200, my math's great. 4 authors at $400, $1,600. Okay, you can deduct that there because obviously that comes off your income, right? All right, so then depletion, that doesn't really apply to us. Depreciation, okay, this one's important actually. It seems, you may think that it's not, but by show of nodding heads, do you guys understand how depreciation works already? Okay, so depreciation is going to be if anyone has bought a desk, if anyone has bought a laptop, if anyone has bought really any significant item that's not an office supply. Okay, so like this year I bought a new laptop. And my husband bought me a desk for Christmas. Okay, it was a Christmas gift, but I can still deduct it because it's for my business. He bought me a writing desk to go in my room, okay? So that goes here. And there's a separate form your accountant will fill out, and you'll need to tell your accountant whether you want to take the full expense in the year that it was taken. Because the way the government wants that done is like a laptop, they'll say the useful life is 5 to 7 years. So normally if the laptop cost $1,000, they'd tell you that because it still has value, that you can only take $150 or $200 a year over the useful life. But Trump has extended the length of time for which we can take bonus depreciation. So you can depreciate the entire value in year 1, which I would recommend you do because that's when you spent the money. So that's where those would come off though. So when you give them something, when you have a depreciable item, you need to tell them the date you bought it, the amount that you paid, and what the item is, because your accountant is gonna, and they do not need the receipt, by the way, but they do need those 3 things. They need to know what is it, Mac laptop, MacBook Air or something, and the date, I bought it on January 10th, and then they need to know it costs $1,062.58 or whatever. And yes, I want bonus depreciation, depreciate it all, okay? Then that number is gonna show up there, okay? And then depreciation adjustment, you don't need to deal with that. But down here on insurance, okay, I don't know if any of you guys have life insurance, but especially if you're the sole breadwinner, you can put.
Bridget, can I ask you one question before you move on?
Yeah.
Is bonus depreciation different than like deducting the actual amount? So you're getting actually 2 deductions for the one item?
No, it's just the way that you have to take the deduction on that particular item. So if you go and you buy pens, or you go and you buy like a USB port, or you go and you buy headphones, those are all things you can put in under like office expense or, supplies. But if you're buying something that is something that would have value that you could turn around and resell, a chair, a desk, you're technically supposed to depreciate it. So sometimes people get a little sloppy and they don't really depreciate things. They just put them in as like office expense or whatever. I suppose you could do that, but technically if you were to get audited and they looked at that receipt, they would say this was supposed to be depreciated. And the reason is that, let's say I buy this laptop, okay, and I buy it for $1,000, and next year I say, I hate Macs, I should never have bought this, I want a PC, and I sell it to you, Amy, and you say, I love your Mac, I've been, longingly looking at your beautiful MacBook Air, I will pay you $500 for it. I'm supposed to recapture that $500. It's supposed to go back in as income. So that's why, now, realistically speaking, do people do that? Probably not, because what could I also say? I could say, well, Amy's my friend. And so I'm going to give her this laptop and she likes me. So she gave me $500. Okay. So, I mean, if it's cash, like, is there a record there? So I think a lot of things get depreciated and bonus depreciated and then never really reported or recaptured. But technically you're supposed to do that. And certainly when you have a car, if you're depreciating your car because for whatever reason you do a lot of author signings or something, so you drive more than 50% of your miles on your car for your author stuff, then if you sell your car back, there's a record of it. You're gonna have a record probably of that. If for nothing else as a trade-in on your other car, whatever. So then you're gonna have to take recapture because the government's not gonna
double. You're not deducting it and then getting depreciation.
That is correct.
You're supposed to do the depreciation. That's what you were talking about.
It is in lieu of a deduction. You're correct. Yes. Does that make sense? Okay. Yeah. So that's just a question of where does it. So you don't get to take it twice, unfortunately. Okay. So then down here you can see like interest, other interest. Well, mortgage interest doesn't really apply to this because it's not like you own a property as part of your writing. But we will get to, you do get to take your mortgage interest, but I'll show you where to take that in a minute. I think we talked about insurance. You can put insurance on there. The only thing you want to be careful of is that if you're reporting insurance here as a business deduction, that means the insurance is being paid for by your business. So when you if you were to die, it's life insurance, then it would be reportable as income. If you're paying for your life insurance on your own with your personal after-tax money, then when you die and you get that life insurance, it's not reportable as income. Does that make sense? It doesn't go as taxable income to your family. Okay, some people are nodding. Hopefully that makes sense. So that's kind of a judgment call you need to make. As a business owner, you could take out an insurance policy with your pre-tax money, but then you're going to have to pay taxes on the proceeds. Your family would have to pay taxes on the proceeds. So, all right, when we're talking about legal and professional services here, you could put covers there, by the way. So like, if you want to break out covers, that's probably where I put my covers. The issue is this. When you go to the final return, you want as many of your things to fit in one of these buckets that's on this form as possible, because if it doesn't fit into one of the buckets, it's going to have to go into other expenses and be broken out with a little list so the IRS is looking over what your crap is and saying, do we think this is an acceptable thing? And I don't ever want them to do that. So usually for other expenses, I'll put in like gifts, you know, because you give client gifts or something like that. Like let's say, you know, Judy tossed Amy's book in a newsletter 3 or 4 times and there wasn't any way to reciprocate. And so she's like, I just really want to say thank you and maintain this relationship. So I sent her, you know, some lotion from the Body Shop or something. I don't know. You can deduct that stuff. Okay. So, I mean, she is your friend. If you're just sending it to her for her birthday, you probably shouldn't be deducting that. But if you're doing it to build a business relationship, you can absolutely deduct that. I take that as an other expense as gifts and I just put it in there. The IRS can see that and you keep a receipt for that kind of thing, right? So you should be covered. All right, legal and professional services covers if you're paying a lawyer, if you're paying for like some kind of online fees to set up your structure, whatever you decide you want to use, if you're paying a filing fee to set up your LLC or whatever. All right. Office expense. Okay.
Can I ask a question really quick?
Yeah.
What is the dividing line between contract labor and professional services?
Okay. So that's a good question. Contract labor is someone you're hiring. So if you have, and I forgot to mention this, if you have a PA, if you have someone who's working for you and you are paying them, their stuff goes right there in contract labor, unless you're paying them as an employee, that's different. If you're paying them just as an independent contractor, which my guess is you guys probably are, if they're paid more than $600, you'll need to file a 1099 and you can just get those forms at like, I think Home Depot, I don't know, you can probably find them online, I think, from the IRS. They're probably available free. My system generates them. Your accountant, if you use one, would be able to generate them. But you need to give them a 1099 if they get more than $600 for the course of the year. But that comes right there, contract labor for a PA or for any of the people that you're paying out. Legal and professional service is going to be like, I got an invoice from my lawyer or I got an invoice from my cover artist. You print off the invoice as the support for that. Does that make sense? Those you do not have to report. Even if you pay your lawyer $3,000, you don't have to report. Some people do. I get 1099s for some of my bigger clients sometimes, but they don't technically have to because there's a documented invoice for that and it's a professional fee. So if that makes sense, like if you pay your cover artist $2,000 over the course of the year, you don't need to issue him a 1099 because he's giving you invoices for each one and he better be claiming that on his income, or she. Well, so Victorine's nodding. She already knows that. She's like, yeah, no, they don't have to send out 9 billion 1099s. Okay, so, all right, and then on office expense, this is kind of a catch-all for anything that might be used in your office. So honestly, if you're redecorating your office, and you buy curtains, you could probably throw that in there. If you need blinds for your office, you could probably put that in there. If you're getting more high dollar things, remember we're looking at depreciation, or I'll get to this in a second because there's a huge one that so many people miss. Okay, so if you have questions again, or people do later, I guess they can comment on YouTube or something there on office expense. I'm gonna kind of skim through it because this is taking forever. I am so sorry this is moving so slow, you guys. So there's also rent for things. I doubt anyone has like a writing space, but if you did have a writing space, you could put that right there in rent other, like if you're renting a room from someone because your kids are making you crazy and you're going somewhere to an office. Repairs and maintenance, especially like, let's say you need to fix your laptop or your phone or something like that, that can go there. Supplies can go right here. So supplies could include a variety of things, but like I was saying before, it could include stuff like paper, software, that kind of stuff. Supplies could also include things. This is another place that you could put stuff like, because for you, remember, supplies don't mean the same thing as necessarily they do for someone else. It is a supply. It could be ISBN numbers. It could be any number of things like that. If you have a subscription and you can't figure out where else to put that, subscriptions are the exact kind of thing you put in other expenses right there. So I really want to, we're going to talk about travel in a second, but I wanted to tell you too, if you pay any local taxes and licenses and stuff go here, okay? I don't think many of you will have them, but that's a state issue, so that's going to be on the scope of what we're talking about today. When we talk down here about utilities, I do not see clients utilizing this a lot, but they should be using it more. I do not think that you could probably be an author without internet. You couldn't do research for your book. You couldn't contact other people to set up swaps. So I would absolutely right here as a direct author expense, put my utility bill for my internet every single month. I put it right there and it'll come right off the top on your business expenses.
Do you have to figure out percentages?
No, not for internet, because whether you used it for some things, which we'll talk about, yes. But for internet, you absolutely have to have it for work, and it costs no more for your family to use it. So you do not need to worry about percentages for that. Now, when we're talking about things, that's something that, and to me, the litmus test for that is if you absolutely have to have it as a lawyer and it costs no more. So if your usage for your internet for some reason is based on how many megabytes you're downloading or something like that, well, then that would be a different story. But if it is a flat fee, like I pay $100 a month to have high-speed internet, then no. Now, if your stuff is bundled and you're paying for TV, internet, phone, whatever together, you need to figure out what the internet portion was and back that out, and that's your direct expense. Now, this is where, does that answer it?
Yes, except you said something about the speed. So like if we need high speed to do this podcast, for example, then it would be, totally legitimate that we have to have the higher speed internet to do the podcast. So that can be
whatever level of internet you choose to have. I think it's just, that's a choice. Absolutely. Whatever you're paying for your internet, whether it's high speed or not, you're fine to deduct it there. You're good with that.
What about like other things? Like I live in Minnesota, it's cold. Like, do you deduct your gas or your electricity?
So we're going to get to that. And the answer to that is you will. And so here's where we're going to get to that right here. So you see right here on line 30, it says business use of your home.
Okay.
Okay. So here is my caveat for that. We're going to go to the other form and I'm going to look through that. Okay. But my caveat for this is, I will warn you, if you use a tax lawyer instead of an accountant to prepare your taxes, your rate of audit goes down by 3%. Now, your audit rate anyway is 0.5%. That's how many people get full-blown audited in the United States every year, okay? But if you use a tax lawyer instead of an accountant or a CPA, your rate goes down slightly, not by much. If you use business use of your home, if you take this deduction, your rate of getting audited goes up by like ×5, okay? Now, that means it goes from 0.5% to 2.5%. Here's the other thing I want to tell you guys is that doesn't mean that you're even ever going to know that you were audited. There are two different kinds of audits. Okay. So is this boring? Am I getting way beyond where we want to go? Okay. So there's two kinds of audits that happen. One of them you'll never know about, and it is called a desk audit. And that means some numbers didn't tie or you just got flagged, and some IRS representative is going to sit down with your return and look over it, eyeballs on your return, and say, does this make sense? Does everything seem to add up? If everything looks fine, you will never hear from them. If, however, they look at something and they say there was a form reported from Amazon that says that they got $9,632 and they reported $9,300, they're going to send you a letter and they're going to say, you need to send us evidence of your stuff. Amazon reported it wrong, and you'll have to either see whether Amazon screwed up or whether you screwed up and transcribed a number. So when there are numbers that you get from any tax form, whether it's your mortgage interest, any number, any tax form that's sent to you, and they say this information was reported to the IRS, you need to check and double check, especially if you're doing TurboTax. You want to make sure those numbers are exactly right. If one of those numbers is off, literally by one number, 963 versus 962, you are flagged for a desk audit. So
well, and then if they find that you did it wrong, then they'll fine you, and it ends up being like, I think we were off like by $5 or $10, and we ended up getting fined like $250. It was crazy.
So what they'll do, they call it a fine, but that's actually the interest that is accrued between when that was due. Usually, unless there's like fraud, which I'm sure there was, then that fine is actually going to be interest that is accrued, and you really want to avoid that if you can. So the way that you avoid that is making sure that whatever numbers are reported on those forms, you want to, if you're a TurboTax user, make sure you double check those numbers. If you are not a TurboTax user, check what your accountant did, because we do a lot of returns and sometimes our eyes cross and our heads hurt and we try not to miss the numbers, but sometimes we do. So when they send it to you and say, please look over this and sign this 8879 so I can e-file for you, pull your tax forms and make sure they got those numbers right. It will take you 20 minutes, but it could save you a lot of hassle. Okay. So that's my caveat on business use of the home. I use the crap out of business use of my home, and it saves me tons of money. I probably save thousands a year because of this, okay? So I am gonna go to, is the screen sharing annoying for people? Okay, so then I'm gonna go on screen share. I'm gonna go to a different, I'm gonna go to this form because I really wanna show you guys This is one of the most powerful tools that people don't use. Where did my other tax? I think this, okay. So I want to go to the home office deduction here. Did it pop up? Let's see. Okay. So we should be looking at the miles and lane runner. Obviously, this is fake. Okay. But let's say that you have someone who is a high income earner spouse, and then you have your writing and you're just getting started like me. So again, as I pointed out, these are phony baloney numbers because last year I made $800, not $43,000. But if we're gonna go down here, what I wanna do is go to the office, there we go, expenses. So it's called a form 8829. And it's expenses for the business use of your home, okay? So the very first thing you need to do if you decide you wanna take this deduction, but I wanna show you the power of the deduction here, okay? So the very first thing you wanna do is take the total square footage of your house, which, can you guys see my cursor when I'm doing this? Okay, good. All right, so you wanna take the total square footage of your house, which for my house, it happens to be 5,500. So, and then you wanna take the total square footage that is used for business. And you can see on this, I have completely inverted those. So those two numbers are wrong. Yay, Bridget, doing this crappy projection that she put together for this random thing. So that's gonna seriously inflate the amount. It's saying business percentage of my house is 100%. All right, maybe, I wonder if, I don't think I did the business percentage on the other one though. I don't remember if I did or not. Let me see if I did, because if I did, it's gonna be way off. All right, sorry about that. The power of Bridget's crappy numbers. Let's see, sorry guys. Maybe
You're
I'll do
just
better.
proving to all our viewers that they don't want you to do their taxes. This is really
Certainly
what
not something I threw together today. All right, well, we're gonna show you on this one anyway, because you'll see where the numbers go. All right, because I can't pull up, I'm not sure where the other one went. All right, so, but those numbers should be flip-flopped. Okay, so it should be 1,400 or whatever it is, 400 for business use of the home, and then 5,500. So it should be saying, you know,
And you're talking about the square footage of like your office or
Yes.
the space
So-
that you use to do this writing.
Yes, and so for me, for my writing, okay, I probably have 300 square feet out of the house. So this would be a different number. But for my husband's, he uses one room to see patients when they come to the house, and he uses another room for storage stuff, and he uses another room for sleeping. So we have a bigger square footage, right? So, but these numbers are off, sorry. All right, so let's see, when we're figuring the deduction down here, these are the things that you can put in. So this is what matters, okay? So we're calculating there are direct expenses for business use of the home, and there are indirect expenses for business use of the home, okay? And what these are, I'm gonna ignore casualty loss and deductible mortgage interest. Well, no, we shouldn't, we don't wanna ignore mortgage interest. So you wanna put that in. So remember I talked about how your Schedule A is your mortgage interest and your taxes? So one of the great things that we can do here is we actually get to take a portion of those off of your business income, which if you are not itemizing, like on that return I showed you before, they are not itemizing. This allows you to take some things that you're not getting any benefit from, because that $24,000 that Trump gives us now for the standard deduction is really high. And so you get the benefit of the higher standard deduction, and you get to take some of the stuff you would normally put on your itemized deduction. You get your cake and you can eat it too. So here, let's say your real estate taxes, you're in Texas and they're really high. Those are my actual real estate taxes. And then let's say your mortgage interest is $5,000 or whatever it is. So you put those two things in, okay? And then you come down here and you can also say, like if you have excess mortgage interest, that would be like if you have, well, it'll be reported on your 1098 that comes from the mortgage company if it is, or excess real estate taxes, that's a whole mess. Or if you just bought your house and so you paid additional ones, but your accountant will know when that applies. Your insurance on your house, which is normally not a deductible item anywhere on your return, is deductible if you were a writer taking a home office deductions. Our home insurance is $2,700. Some of these numbers are real. All right, so the repairs and maintenance, this is where things get a little fun. Yeah.
Am I the only one who is seeing the wrong form?
Oh, is my form not showing the right one? Crap.
Yeah,
Let's
it's showing
see.
it's showing the like base one, the one.
Okay, hang on. Maybe I can pull that one up because I think it actually had a home office deduction and it would have the right numbers. Hey,
There
look, I got it. All right, is this what you guys are seeing? All right,
Now
so
we're seeing it.
look, now we have area regularly used, 400 square feet. Total square footage of the house, 3,000. 13% is business, okay? So then when we look on here, yay, okay, I'm sorry. Obviously, I told you guys, I warned you in advance. I was a technological idiot. All right, so deductible mortgage interest, let's say it's 5,600. Real estate tax is $1,900. So then they add those things together and get $7,500. Okay. Then you come down here. All right. Now this is all tax calculations. Okay. For that. So don't worry about that for now. Then down here, insurance of $1,000, $375 for repairs and maintenance, utilities of $2,100. Now look, Amy, this is where you were asking me. It's cold where I am. So can I deduct gas? Can I deduct my power bill? Can I deduct all of that goes here in utilities? Okay, every single bit of it. Now, if you have something like a cell phone that you need to use for your writing, I'll be honest, for my legal stuff, I use my cell phone all the time. For my writing, not so much. But if you use your cell phone and you have to have it, if you need it for your business, you can put that as a direct expense either here or on your Schedule C. If you put it here as a direct expense, it comes right off on this home office, the expenses of the business to your home office deduction, okay? The other thing you can put here, let's say that you have, I saw some chatter about this on Writing Gals the other day. Let's say that you have a cleaning lady and you've hired a cleaning lady because you're spending your time writing. Guess what? Part of that is deductible. Not a lot of it, but the part that is cleaning your office. So if that cleaning lady's coming in and cleaning your writing space twice a month or once a week or every day, whatever, you get to put that amount in here as an indirect expense. If you're only paying them to clean your office, you get to put it here as a direct expense. Okay, so you'll need to tell your accountant which things you're using and for what. Let's say that you say, hey, I write in the office. Right now the office is a friggin' eyesore. I need to get it painted. It needs new floors. And I want all new, I don't know, whatever, lighting, okay? That is a direct repair and maintenance. You get to put that right here and 100% of that will come right off. But let's say you say my roof needs to be redone. That goes over here in other expenses. Or you say, hey, I need to remodel the bathroom that is closest to the house, but it is the one that I use when I'm writing. I get up and go there. You put that in other expenses, okay? So those types of things you can really get. Now you're only gonna get a tiny percentage of it. You're not getting all of it, but you get to deduct a portion of that as part of your home office. So here, all of those come to $5,000, okay? And then you get, so then of course we're taking a percentage. So you only get 663. You can see that down here now, we're able to take 1663. So when I go up here to the Schedule C, which I think is maybe here, yep, profit or loss from business. When I go over here to the office expense is 680, but when I come down here to the home office deduction, it should be right here. There we go. So $1,663 came off because you are using your home as a place of business, okay? So that can be, depending on how much you have and what your expenses are for your house, that can be a powerful way for you to take deductions that you're not able to take elsewhere. By the way, kind of leading towards Amy's question when she was asking about how the depreciation works, you can't double dip. So when your accountant puts this down on the form, if you also itemize on Schedule A, it's going to reduce it. So they're going to take 13% or whatever the percentage is for your house, and they're going to reduce the amount of your Schedule A interest and taxes by whatever you're taking as your home office deduction, if that makes sense. So you're not going to double dip because it would get you in trouble, but their system should do that automatically.
Okay, a question I have that I think might be pertinent to a lot of people is, does it have to be designated as office space only? Like when you're figuring your square footage?
No, and here's the other thing, and I certainly am not giving this as legal advice, but what you need to think is like, where do you typically write and how big is that room? So for me, I don't know if people can see over there or not, but it's too dark probably. My office is over there. I use it for legal stuff. There's a piano in there. So my kids play piano and practice piano in there all the time because I'm not doing legal work all the time. So that office is used for when kids have school projects, they go in and do them in there, but all my legal work happens in that office. So I write off the entire square footage of that for my office. I also have a storage closet where I keep legal files. I write off both, but I also have shoes in there.
So if I write at my kitchen table for 8 hours a day and we eat on it for 30 minutes in the evening, does that count?
Yeah, no, you can take your kitchen. So what you need to look at is, where do I write? So for me, I write in my master bedroom, and there's a full-on desk and a whole section of it that's dedicated to, this is Bridget's writing area. So that's what I write off for my writing stuff. Because I have two Schedule Cs, right? I have one for my legal stuff and I have one for my writing. And so
you're saying you deduct the whole, like I write in my master bedroom, but I have a tiny little desk area. But I use the bathroom too when I'm writing. I kind of shut the door and sit in here.
So when you're looking at your area, so when you're looking at your area, you can always include for your home office a bathroom, a storage area, your writing room, whatever that room is, even if you're doing other stuff in it sometimes, and a kitchen space. Now, I think it's a little dicey to be like, I'm going to deduct my whole 500 square foot kitchen. Okay. So I usually just add like, cause if it were a kitchenette as part of an office, you know, I add like 150 square feet there. So the reality is the IRS going to come into your house and measure? No. So it needs to look reasonable, and it needs to be something that you're legitimately using, because we're not trying to defraud the government here, but we are trying to look at like, what is a reasonable thing, and what do I do when I'm writing? When I'm writing at home, I go get freaking cookies so that I can keep drafting my words. Okay. So I go into the kitchen and I use that. I use the microwave area, you know, I come get the stuff, I go back to my house. So I deduct my entire master bedroom, because sometimes I write at my desk. Sometimes I write sitting in the chair. Sometimes I write on my bed. And I'll be honest, probably 60% of my writing happens on my bed. So, you know, like depending on where you're writing, that room, a storage area, a bathroom, some kitchen area. So like if you have a 300 square foot room you're typically writing in, I would say 40 probably, because you're going to need a bathroom. That's probably 60 or so square feet, a little kitchen area, and a storage space. So, I mean, that's a reasonable amount in my opinion. So all of that is kind of like, what do you feel comfortable with? If an IRS agent asked you, what are you using? I would say, I am using my bedroom as my writing area. I am using my office as my legal area, right? So my husband uses this as a sleep room. I do not double count, by the way. If you, I think that would be a no-no. So like, let's say that you're a writer, but also a lawyer. I would not use that office and the writing. I could maybe write in both. And that's also my legal area. That's, you know, for obvious reasons, you shouldn't be claiming like 3,000 square feet in various businesses for a 3,000 square foot house. Like I was showing you before, that looks kind of ridiculous. All right.
So, like, cause I write all over my house. So
yeah, so what I would try to do, Judy,
just choose an office.
Yeah, I would pick one of the rooms that you do some writing in, but also maybe you store your stuff, and I would call that my writing area.
Okay.
I would say it's your basement, because that's the one I always see you in.
Yeah,
when
we're doing my
our
basement for the most part. So
yeah,
I biggest room. So
that's nice. Makes sense. So anyway, all right. So that's kind of where I am on that. So that's home office deduction. Only other thing I was going to mention to you guys that is and I don't know how many people this may apply to, but if you are self-employed and you are the breadwinner for your family, or your breadwinner doesn't have insurance, you can claim any health insurance coverage right there on your self-employed income. It comes off of your business income. So like, let's say you paid $6,000 for health insurance, it goes there. Now that's only insurance, and that's dental insurance, health insurance, vision insurance, any kind of health insurance, if that makes sense.
So I have a question for you. A lot of us have what's called healthcare, Christian health ministries.
Yeah, I take it off as health insurance. I use Liberty.
That's health insurance. And then like, we don't get dental insurance, but we pay a dental, like the dental practice we go to.
So this is the thing.
Like
yeah. So if you're paying the dental practice, like an annual amount, like I give you $1,000, so you'll do all our dental care, I would take that as insurance. But if you are just saying, hey, I just go in and pay for my cleanings, you might want to look into dental, because we almost canceled our dental insurance. But remember, my husband's self-employed. So I looked at it and said, if we paid cash, we would save $80, but it won't be deductible. So you can on Schedule A deduct health insurance, but it's like a real to the face, because the way the health insurance deduction works on Schedule A is, first of all, you have to itemize, which, like I said, with the new $24,000 standard deduction, a lot of people will not be itemizing this year. But the second issue is that on top of needing to itemize, you have to hit a threshold. And it's not like if you hit it, you can claim all your medical. It's like, unless you get to that threshold, and it's like a percentage, I think it's like 10% of your income. So let's say you make $100,000. If you don't have medical bills that exceed $10,000, you can't deduct anything. And you can only deduct the amount that goes over. So if you have medical bills of $12,000, you can deduct $2,000 on your Schedule A. If you're not itemizing, you get nothing. And it's out of that $12,000, you can deduct $2,000. If on the other hand, you pay $1,000 for dental insurance, and then you don't pay anything for dental, you can deduct that $1,000 because it's insurance. Makes sense?
It's what we use is like, he has like a paid program for like the year. You pay an X amount and you get 2 cleanings, and then you get a certain percentage off the work. That would not be considered dental insurance.
Probably not. A lot of it depends on what your invoice looks like. I would talk to my provider and I would say, is there any way that you could call this a family dental insurance plan? You know, like you're self-insuring through the office, because if he can put anywhere on the invoice that this is like essentially, because it doesn't have to be insurance provided by Aetna or Cigna, you know, it's just any kind of insurance. So if he says, hey, this insurance only covers these things. So a lot of that has to do with how he's presenting it. Anyone who's self-employed would be better off if he called it an insurance plan through his office and just said, these are the defined benefits. Because then, now look, you can claim whatever you want as insurance. I already just told you 0.5% of people in America are audited. But I'm not advising you to do that. I'm just saying
you just have to be able to justify it. So if you deduct it, then you're going to have to
Yes.
support it.
If you are audited and they come in and look at it, you're going to need to have some kind of paperwork that says this was insurance and not a payment to a dental office, because that should go on Schedule A. Does that make sense?
Got it. Okay.
Okay.
Yeah. I have one other question too.
Yeah.
So what about childcare? And I use like my gym membership. Half the time I go to the gym, I'm using it to work, like as childcare to work. And then the other part I'm working out.
Yes. So here's the thing that you need to know about childcare. Childcare is on a completely different schedule, and you need to have both spouses working. So if you have one spouse who's staying home and you're paying for childcare, you get nothing. If both of you have earned income on the return, like showing return.
So I'm self-employed, my husband's self-employed. So that would consider us both working.
Yeah. Well, as long as you're both reporting income. If he's self-employed and doesn't earn anything, then that's going to be a tougher sell. But if he's self-employed and you both have earned income on the return, then you can absolutely include childcare. And I mean, sure, it's gym. The issue is that what you're going to need is, so if it goes over a certain amount, and I can't remember off the top of my head what the threshold is, you have the number for what you're paying. So is the gym's policy that you can only have the kids there while you're working, or do they know that some people use it as childcare?
Both. They're like, you can go and drop the kids off, and I just go work in the cafe for 2 hours of writing time. Okay.
So if they're aware of that, they'll be able to give you their taxpayer ID and your numbers for this is what I pay. Because to report it as childcare and get a credit for that, have to be able to report so I'm employed, right? And I worked at home. So I always paid like a nanny. I never used like a daycare or something. So I had to report it through their social security number. But you have to have something to report to the IRS to say this is where the income went. Because if you don't, then the IRS says, yeah, right. You know, like, I don't believe you. So
you said it's got to be tax ID and what else?
A tax ID and then the numbers. So, and it has to be broken out. Is it broken out per child? Like, are you paying? It is. Okay. So then that's easy. So I paid $500 for child A and $500 for child B or whatever. So you just need whatever the numbers are.
They have to give me that information. I can just
they need to give it to you. Yeah, you have the numbers. That's fine. But they need to give you their taxpayer ID so that you can tell. And so you really ought to tell them, because otherwise they're going to get flagged from the IRS and they're going to be like, what the heck is going on? I bet this has come up before. If they know that people work out and also sit in the cafe and work or do what other, stuff, I bet people have asked before. Okay. But you have to be able to report where that child care money has been going. So you need a taxpayer ID and then you need the number broken out by the kid.
I mean, it's not that much. I mean, I think I pay $100 a month for a gym membership.
Still, if you think about it, let's say you get 20%, and I can't remember exactly what it is, but I think it's pretty close to 20%. 20% of $1,200. I would like to get that. Yeah. I mean, it's enough that it might be worth the hassle of asking them. So, and one of the questions, I know I'm getting ahead here, but one of the questions that someone asked, I think it was Lindsay Armstrong asked, how do you know whether someone's a good tax preparer when you're looking for someone? Like we said, Bridget doesn't want to do your return. So when you're looking for somebody, there are a couple of questions you can ask them. First of all, the way is a referral. And a lot of people are like, but how do you know that they're good with authors? It doesn't really matter if they're good with authors. What really matters is, are they good with self-employed people? So what you want to do is find someone who's comfortable handling self-employed returns, or small businesses if you're incorporated, and it's a little more complicated. But as long as they're good with that in those categories, they'll be fine. But you want to ask your tax preparer. So we're getting long. Do we need to cut off? Do people need to go? We almost there? Okay. So my brother-in-law, right after Whitney and I, my husband and I, had just gotten married, my brother-in-law came to me and was like, so I know you do taxes for work. I was hoping you could look at my return because H&R Block says that I owe $1,700. And I was like, well, it's H&R Block. They're probably right, but I'll take a look at it. So he sends me his stuff. And what you're going to find out is that most tax preparers are lazy. So there are a couple of things that I can carve off a return and it saves me. Like a typical return that's simple, just a couple of schedules, I can do in an hour and a half. If I add some extra crap to it, it might take me 3 hours. So what I made per hour just got cut in half, right? If you have a good preparer, they don't care. What they want to do is get your name down. So when I looked over Ivan's return, H&R Block charges by the schedule. So you'd think that they would want to add as many as possible, but there are a couple of schedules that are irritating. The home office deduction is one of them. Charitable deductions are another one. Now, if all I'm doing is putting in a number, I donated $20,000 to my church this year. That's easy. Everyone will do that. When we're talking in-kind donations, if you guys are not making in-kind donations every year, go through your crap, donate your kids' clothes and toys. Go through your crap, donate those picture frames you don't need. Every single time you get a receipt and you write down every single thing that you donated, you will be shocked at the value. And what you want to do, it's annoying for you too, but you go to Goodwill or Salvation Army or somewhere and you find they will have a valuation listed and it will be something like kids t-shirt, $2 to $8. You're like, what? I wouldn't have even paid that new, right? But you can put down there, it was in good shape. It was worth $6. I gave 12 of them. Suddenly you have a $72 deduction. And guys, that comes off like cash. So what you want to do is make sure that your donations are less than $500. If your in-kind donations are less than $500, they do not trigger any kind of desk audit or anything else if each one is under $500. But your tax preparer has to enter like 15 things every single in-kind donation. So when you're looking for a tax preparer and you want to find someone who cares about getting your numbers down, you ask them, do you think it's a good idea for me to make donations to Goodwill and Salvation Army and value those and keep receipts? And if they tell you, oh no, that won't really save you any money, it's just a big pain, bye-bye. Okay, because my mom, I told her about this. She started writing down everything she donates. I mean, I get like 100, I'm exaggerating, but it's probably 25 receipts every year from all of her in-kind donations. And it saved her $1,100 on her taxes last year. It took me like 2 hours to enter all of the crap because you need to give your preparer the receipt because they have to look up the address, the name, they have to write down a description of goods. They don't have to write down everything, but they have to say like clothes, electronics, housewares, every single receipt. They have to say the date, and you guys need to be writing this down. The date, and it's approximate, but write down on it the date that you got the stuff. So if I got a dining set in 2011 and I donated it in 2018, I have to write down, got it in 2011, donated in 2018. If you're giving a box of stuff, you're not gonna know, so you just pick an approximate date. But you have to enter all this stuff, the date it was donated, the date you got the stuff, a description of the thing, what your value is based on, and you guys are gonna have a little list next to it that says, this is the crap I gave. This is the value, okay? It's annoying, but $1,100 my mom saved last year. Do it, right? Like, so if you're looking for how do I find a good tax preparer, ask them if they think it's a good idea. I give a lot of stuff away to Goodwill. Do you think I should, get receipts and give you those? Oh no, you shouldn't do that. Okay, I'm gonna look for somebody else. Or yeah, that can save you a lot. That's a good preparer who cares about getting your number down. Because when I did items, yeah.
I was gonna say, is there a maximum amount of charitable donations you can give? Like if I give a lot to my church, will I like exceed that threshold and then the in-kind donation?
I think it's like 30% of your income. I doubt you're gonna be over it. But I mean you could, but I doubt it.
Well, like last year we paid money to our church, but we didn't actually pay it until January of this last year. And so
you're gonna have double that. Yeah.
Yeah. And so we're like, well, there's gonna be a threshold that we're not gonna.
Yeah, it's something like 30% though. So you would have to give a lot of free stuff to exceed that 30%. So that's something to look at, especially if you, so for us this year, we paid in 2018, doubled down. We paid like, so I'm LDS, like I said, so I pay tithing. So we paid 2 months of tithing for 2019 in advance to get our income down low enough to fall below the QBI threshold so we can get our deduction. Because once you go over, you lose the deduction. It cost us a lot of money. So anyway, you can do stuff like that, but we would, anyway, that is something to think about. It's like 30%. But so what I was going to say though, is the huge difference when you get a good preparer, because I told you H&R Block said he owed $1,700. We got him a $2,300. I got him a $2,300 refund. It's like a 3,000 something, almost a $1,000 swing. So you don't want a bad preparer. They can cost you a lot. You want to make sure you're not dealing with someone who's lazy and just wants to cram the return through. Okay. All right, I don't know how much time you guys have left. I don't know how much you want to talk about. That was my list of deductions. So
I think we were all just like, wow, this is good because now we're entering into 2019. Now I know what I need to keep a list of.
Yes.
And that to maximize my
I think this might be a series that we need to keep.
Yeah, we might have it back because we have lots of questions.
We answered one question.
we got through one. I talked too much.
No, I think there's a lot to know. We're just dumb. We don't know any of this, so you have to like tell us what we should know.
Well,
did you see these ones about books, like specific payback copies you donated? So like if you purchase.
Oh yeah, okay. Yeah, some of these specific questions. So a lot of the things people are asking about, like if you donate to giveaways, absolutely keep track of that. Keep track of anything you donate. Now, if your donation is BookFunnel and I'm giving something away, you can't really count. If you're gifting it on Amazon and it costs you money, keep track every time. If you buy, okay, so this is a good time to talk about this probably, until you guys want to cut me off, but the author copies, okay, I bought 50 copies or something of March when it first came out. And I didn't really have the intention to sell them. I thought I would send them to reviewers. I thought that I would give them to family and friends to try and get people reading it and thinking about it. And my kids wanted, like, my 6-year-old carries a copy around. She can read like 7 words. So but anyway, so like they're trying to read it. My 7-year-old's trying to read it. Their friends want copies. And so I spot a lot. That is absolutely a business deduction. Not because I'm giving it to people for Christmas. I'm losing $5 every time I give one away. That there is some kind of buzz, and there's like people talk about books and then people put up reviews. Even if you give out 20 copies that you paid for and no one is at all, you gave them out in the hopes of getting a review. That is a business deduction. So that question on that one. Now, when they're talking about books for courses stuff, this is where you start to enter a gray area. Okay. So I bought Story by McKee, best writing book other than Story Genius by Lisa Crone that I've ever read. Those two were like transformative for me. Night and day difference in my writing. I had to rewrite every book I'd written, okay? Absolutely deduct craft books, all right? I did not buy that book to sit around on a Friday night and keep myself busy, all right? Let's say you have a Kindle Unlimited subscription because you need to keep up with the market and you skim or read over books that are in there, totally a deduction. You write off that Kindle Unlimited subscription, absolutely you do. Now, this is where we start to get a little fuzzy, right? You want to do some market research, but also you love to read romance. So what about the 27 books that you bought this year and read while you were on vacation? You can probably deduct those, okay? You need to be printing off a receipt and putting it in your Amazon thing. Let's say you bought 12 other books because you also like fantasy, young adult fantasy, but you don't write young adult fantasy. I probably don't deduct those. So if you're buying books that are in your genre to read in your genre, even if you're enjoying them, I think that's a valid deduction. If you're buying books because you like to read and you have no intention of ever writing that and you're not writing in that genre, I'd say probably don't deduct those. So when people were talking about, yeah.
What about movies?
Yeah, because doesn't it all count for research, really?
So this is probably a good time to talk about the travel too, because these fall into the same bucket, okay? So if you're going to see a movie, and you are going with your husband or with someone, if you're going alone to do research, you should write that off. If you're saying like, I wonder if this movie that I've heard about would be a good audience for me to look up on Facebook. It's not necessarily, I'm just going to check it out. You can deduct that. I don't even think that's that much of a gray area. You're trying to look for an audience to see if it connects, that's fine. Or you're renting it on Amazon Prime and it was $4 and you want to keep track of that, be my guest. Print off a receipt, okay? Like print off a copy of it or put it in your file, but that's fine. But you have to start to think about like the point of diminishing returns, okay? Let's say your tax rate is 20% and you're going to go with your husband to a movie that you think you could deduct because it might be something or another. Well, you're gonna have to say like, let me buy my ticket. Hang on, honey, now you go buy your ticket and I'm gonna keep this $7 ticket and I'm gonna put that in a receipt. If you wanna do that and you think it's legitimate research for your book, I think that's fine. But let's say you write romance and you go to see Aquaman. Don't include those. That is not research. Even if there's a love interest, I think that's a stretch. So, you know, you kind of use your like litmus test of what's acceptable. So let me give you an example. I wrote a book. I haven't put it out yet. It's called Horse Lords. It's a paranormal romance, okay? It's about a witch's curse that results in a guy, well, this whole group of people being horses, okay? And they live as horses for like hundreds of years. And the main character then touches this guy and it turns out he's a man and she's the witch's descendant, which is the only reason she can turn him back, okay? But the entire book takes place around something called the Grand National, okay? Which is this huge steeplechase race in Liverpool, okay, in England. And I'm going to the Grand National with my daughter because when I wrote this book, I had so much fun researching it and watching all these races over and over on YouTube like a complete lunatic that I was like, I'm going to that. Because my daughter rides, all my kids ride horses. And so I live in the horse world. Am I going to love that trip? Absolutely. Am I going to deduct it? Probably not. I might deduct the cost of the Grand National. My ticket only, not my mom's, not my daughter's, but just my ticket of going to the Grand National because I'll probably get some cool images I can use for promo. And it will help me if I release books of being authentic, okay? So you gotta be reasonable on that kind of stuff. Like if you say, I wanna write a book in Italy, I think I'll deduct my trip to Italy. Maybe you could deduct like the plane ticket, but you gotta, so when you're, the litmus test for the IRS is, which things, if you go to a conference and then while you're there, you spend 3 days with a friend, you can't deduct the rental car use during the 3 days that you're hanging out with your friend or driving up to the mountains to go skiing or whatever. You can only deduct the portions that are going to legitimately benefit your business. So you kind of have to do the same thing here. If you're going to Italy and you have a wonderful dinner and it gives you an idea and you're going to use that dinner and a scene in your book, you could probably write off that receipt, but maybe not your plane ticket, your hotels, and all of your trips in and out of the Vatican or whatever. So you can't but let's say your book's about the Vatican. Well, you could probably deduct the $23 you pay once you convert the euros for your ticket to the Vatican. Does that make sense? It's kind of a reasonability test on trips and stuff.
So I'm wondering, because I went on like a road trip with my family this summer, and as we were on the road trip, I outlined this whole book where this girl goes on a road trip that is like basically like my whole trip. Can I deduct that? Like, what can I deduct?
So the question is, what parts of the road trip would you be deducting? Because if it's food and stuff, and we haven't really gotten to this yet because so is this like our discussion of travel?
We're morphing into travel, aren't we?
About travel now. So if we're talking about that, what you have to be careful of is, all right, so when you're a writer, you have a home base, okay? So if your home base is wherever you live and write all the time, all right? So for me, Richmond, Texas, okay? If I have to go somewhere else, like a conference, okay? If I'm going to a conference, my plane ticket is deductible. The fee for the conference is deductible. And here's the IRS's question. Are you going to this conference with an intent to generate income? Are you making contacts that will help you with newsletter swaps? Are you learning things that will improve your craft and hopefully increase your sales? Are you going to basically be more profitable as a result of going to this conference? Then yes, the conference and all of that stuff is deductible. Meals, the IRS understands that whether you're writing or not, you have to eat. So all of your meals, if they are for a business thing, like you're traveling, so you're in a conference, you can't just make yourself a sandwich cheaply at home. You have to eat something out and about. You get to deduct 50% of your meals. So you want to keep track of all of your meals, whether it's a sandwich or whatever. But what if you're traveling with your sister or your mother or your husband? You have to carve theirs out. So if you're like saving your receipts because you want to deduct meals, you can't be like, well, I was at a conference. I paid for me and my daughter. It was $80. Okay. Now, let's say you're entertaining a client or an agent or a publisher and you pay. That whole thing is deductible. You get it? So like you kind of have to look at like which part of this is. And so what I do is when I have a receipt and I'm going to lunch with a client, I write down client dinner. If we're at dinner and my husband's a medical director for the hospital, so we have to go to dinner sometimes with like, let's say the people that are in charge of the chest lab, okay? So we go to dinner with them. I'm stuck at this thing. I don't want to be there, but the food was good. We deduct the whole thing, okay? Because that is a client meal. Makes sense?
So
but yeah.
So like a lot of times I'll go out to dinner with my husband and brainstorm my books. Can I deduct that as like?
If you're working while you're at the meal, see, this one gets a little dicey because writing could technically be done anywhere, but you are getting work done. So I'm going to go with your call. Save
you
the
have
receipt.
To defend it. That's the thing.
That's the thing. So just save the receipt and write down business lunch. Remember, you can only deduct your half, not your husband's, but write down outlined blah, blah, while eating. So when I had a ton of little kids at home, I could not write in my bedroom very often. I did all my writing in Panera. Had I been making money instead of just writing into a void at the time, I could have saved all of those receipts from Panera and deducted 50%. Because that was essentially my office. It was the place that I had to eat. That was a work meal. But if, however, I'm like they're writing, I eat lunch, and then I pick up some dinner on the way home, that's not a work meal. Does that make sense?
So can I ask a question about travel? So let's say I plan a trip to plan a series. So like if I want to write about those little towns in Italy that, pay people to come live there. So I am planning a trip just to go to Italy to write this series or research this series. That would be something you could deduct. So
here's the
instead
deal.
of being like, my whole family and I are going to Italy and I'm going to do some research and I'm going to, and then I'll deduct the whole thing. But if I'm like, no, my entire purpose of going to this place is to learn for this series, that would be, then I should be able to deduct the whole thing, right?
So here's what the IRS is going to look at, right? So if Debbie McComber goes to Italy because she's writing a book on it, she could probably write a better book and make $8 million more than she was going to make because she wrote it authentically. and it's a good book. If you are taking a huge tax loss, you need to think about that, because but let's say you have income and you're trying to offset some of your income and you are writing a book about it. That's why when Judy asked if she could deduct road trip expenses, if she said, I wrote my book while I was on a road trip, I would say no, because you don't need to be on a road trip to write the book. But when she told me it was a book about a road trip, then that's when it becomes a maybe for me. And that's when I say, what are you talking about deducting? If you're talking about deducting hotels, and it was you and 9 people staying in it, and it's like a 3-bedroom house, probably not. But if you're squeezing everybody into a hotel, you would have had to get 1 room anyway. You could probably deduct that because your book is about a road trip. So you're doing the experience as research for the book. Okay. So your Italy trip, for instance, if you're going there to research, yes. If, however, you spent 3 of the 6 days that you were there going on tours of things and whatever, maybe you carve out those 3 days or your expenses from those days, the time that you're there. So within reason, right? That's why I said when I go to Grand National on a trip with my daughter to see the Grand Nationals, okay, I can deduct probably my entry to the event because I wrote a book about it and I'm going to promote it and I want to make sure that it's on. It might be a little excessive. The IRS might come in and be like, And what I'll tell you is the IRS, if they do a desk audit, if they're pulling your numbers, they're going to look at year over year. So they're going to say, she's never taken more than $2,000, which is probably a conference or something. This year, she took $12,600. What the crap is that? And you're going to get audited. So you want to think about that kind of stuff when you're looking about it, what's reasonable. So when I have clients so I'll give you my brother as an example because he won't mind. My brother was making he had an entry-level job where he was getting all these qualifications, okay, for his career, get it on track, and then he got his big job. He's Mormon. So he paid at $40,000 a year or whatever he was making, he paid 10% tithing. And then all of a sudden he gets this job where he's making a ton more and he pays 10%, but the numbers went from here to here on his tithing. He got audited and the IRS was like, the only thing they audited him on, by the way, it wasn't a full-blown audit. It was just his charitable. They said, what the crap's going on with your charitable? We want to see your receipts. We don't believe that you went from 4,000 to whatever this huge number is. And so we had to say, we sent in a letter saying, this is from the Church of Jesus Christ of Latter-day Saints. We pay 10%. It's a percentage, not an amount, because most people, no matter what they're making, put the same $20 into the collection plate every week. So when you have an anomaly of any kind, it's going to trigger a desk audit. The computer will spit it out and someone will look at it. And they may look at it and say, oh, that's fine. I know someone who's Mormon. It's probably a percentage. No big deal. But they may also look at it and say, what the crap? And then you'll get a letter and then they'll audit your other stuff. So you want to, that's why I say within reason. A $12,000 trip to Italy, I'm not saying that the IRS wouldn't say it's okay, but you want to be careful which things you're claiming on there because it could end up being a giant headache for you later.
Okay.
So
I'd like one more question. So let's say I go on this trip, solely research, but my husband just comes along with me. I wouldn't deduct any of his stuff, but they would look at that as, oh, well, it's a trip because you took together, but I'm saying, no, he just, like what you said about your dinner, when you go to dinner with your husband, you don't want to be there, but you deduct it all. So here's where
I come in on that. So because this comes up all the time with so my husband is like a physician, right? They have all these medical conferences, okay? And the idea is we'll do a medical conference on boring emergency medicine crap in Hawaii. And then the hotel's happy and we're happy because we get this enrollment and the doctors kind of come and go for their CME. Maybe they pay attention, maybe they don't. We do some other crap, you can write it off, okay? The answer is this. You can write off the days, and this is what the IRS says for this too. You can write off the days that you're at the conference. If the conference runs Thursday to Saturday, you can write off your hotel for those days, whether it's you and your husband or not. So if you're there for 7 days, do you really need 7 days worth of research? Well, maybe you're visiting sites for your research for 7 days and your husband's tagging along. Then you probably write that off. If you're visiting sites or if it's just the ambiance of Italy and you visit one site and then you go tour, your thing takes place in Venice, but you go to Florence and Naples and Rome, maybe you don't deduct those days. So that's kind of a reasonableness, and you want to keep a log of it, right? You want to say chapters, blah, blah, blah. So if the IRS comes back in and says, why the crap did you deduct this? You say, because I went to these specific sites. Here are the pictures I took, see? Mm-hmm. So you just have receipts that make sense and a story that makes sense. And if you're, and a lot of this frankly comes down to integrity. So for me, when I say this is my litmus test, I'm looking at is this reasonable? Do other people lie about it and say the whole thing's research? Sure. But I'm always looking for what is the maximum amount that I can deduct and still sleep at night? Feel honest about what I'm doing. And also get in trouble because you do not want to get slapped with fraud. That's a whole nother mess. So
I get the whole, if you're getting a vacation rental and your whole family's there. But what about mileage there and back? So like I've written 3 books based in Destin, Florida, that are very specific to the location. And I considered being there as part of my research. So would my mileage there and back count?
Yeah, I would include that, but I would just include that. I wouldn't put that in travel expenses. I would put that in mileage. So like when we were talking about your mileage number, I would just say, hey, this is part of my mileage for that. If you drove to a conference, if you drove out somewhere to research it, that's absolutely, that. I don't even question that. I'd say add that to your mileage log. So
we could probably ask you questions all night long.
Yeah, I was going to say, I think that's a good place to stop, and then we'll get you on. I think that's good just for anybody who's thinking about getting their tax information together from last year to this year. I think this will be super helpful. And then we can talk about the other stuff.
Is there one more question that I can answer? Because I did want it. There were a lot of people that asked about hobby versus business. And I think I can answer that in like 3 minutes. So I just wanted to say really quick, the IRS has a whole list. Again, I didn't take a screenshot of it, but this is like an IRS promulgated regulation. You can't see the details, but I'll just tell you. It's a question of how do you distinguish between a business versus a hobby? They have like 10 different elements that you're looking at. So a lot of people are like, oh my gosh, it's 3 years out of 5. Okay. So there is a safe harbor. Is anyone familiar with what the word safe harbor means? Or is that a legal word that no one knows? Okay. So, all right. So there's a safe harbor in legal speak means that if you comply with it, the IRS doesn't even question you. So there is a 3 years out of 5 rule. As long as you have earned income that exceeds your expenses for 3 years out of 5, the IRS assumes that it is business and not a hobby. So but you can have 2 years frequently. Most businesses have their loss at the beginning. So you could have 2 years of losses before you need to start claiming income, and they will still consider it to be automatically a business, unless your business is something like surfing. My business is surfing. I occasionally do a contest. There are some things where they're going to look at it and be like, that's probably a hobby, man. But if you're writing, they're going to probably assume that this is intended to be profitable. As long as you're profitable by year 3, you're in the safe harbor. One's going to question it. Even though, let's say that you're really trying, okay, and you lose money, because remember, we want to lose money so that we're not paying taxes, okay? So for the most part, I didn't get into some of the other stuff, but by and large, we want to get our income down as much as we can. Your tax preparer is not doing their job if they cannot get your income down as low as possible, okay? So, and the government understands there's a difference between book loss, deductions on your house, deductions on like your cell phone and your internet, okay? Self-employed, you're trying to get that number down, all right? Because the self-employed tax is high. So there's a difference on those things. If you can prove, these are some of their elements, okay? Do you carry on the activity in a business-like manner? In other words, are you keeping books and records, okay? Are you putting time and effort into the activity that justifies it as a business? If I'm surfing 3 hours a week, that's not a business, okay? If I'm writing an hour or 2 a week as a hobby, not a business. You're right, you're cranking out several books a year. I really do not think that the government is gonna come in and say, I think you're just doing this for fun to fleece us, okay? So whether you are changing your methods of operation to attempt to improve profitability, there's a ton of factors. I don't need to go through all of them, but I think you get the idea. You don't need to be afraid of claiming your income on this. The government understands that your business may lose money, and it may lose money more than 3 years out of 5 if it's something that you love as a book loss, okay? That's all right. So I want people not to be stressed as much about whether or not it's a hobby. There is a 3 years out of 5 profit safe harbor, but even if you don't comply with that, it's fairly easy to give them evidence of the fact that you are in fact not a hobby, you're a business, so.
Anyway. It's good to know. Awesome.
So, all right. And then if you guys end up wanting to have me back, let me know and we can go over some of these other questions. If not, I think they can probably answer. Anyway, whatever, you guys let me know later. But
you did a fantastic job, and I keep asking questions because you're really knowledgeable and did a great job.
Yeah.
Oh, good.
Awesome.
And
So
we did not have any questions on the Facebook. I'm sorry, on the YouTube channel.
Newsfeed. Okay. Okay, good.
My prediction came true. That people were just going to be taking notes and not asking a whole lot of questions.
Since we already have a lot of questions.
Mm-hmm. Okay,
well, that's why I gave them Monday. I was like, you guys now have 4 days to come up with questions because everybody has tax questions all the time.
Yeah, right. So good. Hopefully they can watch through some of that and that'll give them some of the deductions I can take at least since we got through one thing, deductions and travel.
Yeah, I'm totally going to watch this while I am doing my taxes so that I can make sure I know what I'm doing.
And I think it's officially our longest episode ever.
Yeah.
Sorry.
No,
This is all good stuff. Okay. So we might be talking with you some more later. We'll see what we can arrange. But that's all that we have for tonight. And we're so thankful that Bridget was here with us, and make sure you check out her books too, because they are awesome. And she has several of them out already. So, and if you want to join our Facebook group, we're called the Writing Gals, and it's a great place where you can learn all kinds of things, ask questions, and it's just a great community. And also, don't forget to like this video and subscribe to our channel so that you are updated on when we're on here and don't miss an episode. So thanks for staying up late with us.
Bye.